Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Markets are supposed to be mechanisms for price discovery. That's the theory. Markets are also supposed to be efficient. Millions of buyers and sellers, each acting on their own information, come together and arrive at a price. That price is supposed to reflect supply, demand, risk, cost of capital, and expectations for the future. But in the real world, markets often experience distortions. Sometimes those distortions are created by regulation, sometimes by central banks, sometimes by leverage or scarcity, sometimes by fear, and sometimes by the simple fact that people trading the market are not the same people consuming the product. Global crude oil prices are a perfect example. Some of you might remember back in 2020 during the pandemic that oil inventories had swelled to such a high level that futures contracts faced deliveries with no storage capacity to accept the oil. As a result, oil prices went negative briefly. If you could find some storage capacity at a reasonable price, you could make a fortune. Now, in recent days, oil futures have fallen on the sentiment that peace talks in the Persian Gulf could reduce the risk of major supply disruption. That makes sense on one level. If traders had built a war premium into the price of oil, then any credible sign of de-escalation would cause that premium to come out of the market. But here's the paradox. The headlines change faster than barrels of oil did. A peace framework, a ceasefire, or the reopening of a shipping lane does not instantly refill storage tanks. It doesn't restore shipping confidence, and it certainly doesn't normalize marine insurance. It doesn't instantly repair disrupted logistics, and it doesn't instantly rebuild those global inventories. An oil tanker carrying a few million barrels of oil halfway around the world is traveling about the speed of a bicycle. It's going to take several months for the oil to reach its destination. Now, a paper market can move in minutes. The physical market moves in months. That difference is where the distortion lives. The futures market is a financial market. Traders are not necessarily buying oil because they need to refine it into gasoline, diesel, or jet fuel. Many are buying or selling contracts based on expectations, based on partitioning, on risk models and headlines. A futures trader can sell oil because the probability of conflict has declined. A refinery cannot run on probability. A refinery needs actual crude oil delivered to the right place at the right time with the right specs. And that's the difference between financial pricing and physical supply. US EIA, the Energy Information Administration, has estimated that global oil inventories will fall by an average of 6.3 million barrels a day in the second quarter of 2026, and it's forecast that oil prices would remain elevated until global oil flows return to normal and inventories are replenished. That's the physical side of the market. Now, Reuters has also reported that oil inventories and emergency reserves have been rapidly depleted, and that even if the conflict ends, it could take months before the Middle East production and exports return to pre-war levels. That's just to restore steady-state production levels. Many of the inventories are at tank bottoms, and those need to be replenished. That's going to take months longer. So we've now got two different markets telling two different stories. The futures market says the risk is gone. The physical market says inventories are still depleted, and both can be true at the same time. So what makes the commodity market so interesting and sometimes dangerous? The problem's not confined to oil. We see similar distortions in real estate. A lender might value a property based on interest rates, while a buyer is underwriting future rent growth. A seller might price a property based on replacement cost, while the buyer is constrained by net operating income and debt service coverage. A developer might believe a project is worth building because the market needs housing, and while the capital markets say the project can't be financed at today's rates. All of these are versions of the same problem. The asset has one physical reality but multiple financial interpretations. Oil is no different. The physical reality is the world consumes roughly 100 million barrels of oil a day. It's the lifeblood of transportation, agriculture, construction, shipping, and many different forms of manufacturing. But the financial interpretation changes constantly. So one day the market is pricing in a war risk. The next day it's pricing in peace. Then it's pricing recession. Then it's pricing OPEC capacity. Another day might be pricing Chinese demand. The price changes faster than the physical system can respond. And that's not necessarily irrational. That's because markets are forward-looking. But forward-looking markets can always overshoot. If traders remove the war premium too quickly, oil prices fall even when the physical system remains tight. Eventually, the physical market has to assert itself. That happens through inventories. Inventories are the shock absorber in the commodity market. So when supply is interrupted, inventories are drawn down. If demand weakens, inventory builds. And when inventories are comfortable, the market can absorb surprises. But when inventories are near operating minimums, the market loses its cushion, and we are at that point right now. So this is where investors often get caught on the wrong side of the trade. They see the headline, they assume the price move has solved the problem, but the lower prices don't create barrels of oil. Lower prices don't refill the tanks. In fact, if prices fall too far while inventories remain low, that can stimulate further demand. It can create a bigger problem and amplify the next spike in prices. Lower prices can mean more demand, but it can also mean less drilling. So we have a situation right now where oil prices are absolutely distorted. It may last for days, maybe for weeks, but it will not last forever. And commodities are different from financial assets. A stock can trade at a valuation that seems disconnected from earnings for years. A bond can be influenced by central bank policy for quite a long time. But oil has to be delivered. It's got to be refined, and then it's going to be consumed. And at some point, the physical market forces the financial market to reconcile with reality. And that's the lesson for real estate investors. Prices are not always truth. Prices are simply the current expression of market sentiment, of liquidity, of fear. The job of the investor is to separate price from value and sentiment from fundamentals. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.